You just watched your investment drop 20% in a single week. Your stomach drops, your hands are shaking, and every instinct in your body is screaming one thing: sell. So you do. You sell everything. And 2 months later, you watch that same stock climb back to an all-time high. Sound familiar? Here's the painful truth. You didn't lose money because of bad luck. You lost money because of your own brain. And before this video ends, I'm going to show you exactly how your mind is sabotaging your portfolio without you even realizing it. The scary part? It's happening to almost every beginner investor right now. Let's get into it. Here's something most finance teachers skip completely. Investing is not really about spreadsheets. It's not about finding the perfect stock. It's about understanding the one unpredictable variable that controls every single financial decision you will ever make. Your own psychology. Our brains are ancient. They were built to survive predators, droughts, and tribal conflict. They were not built to hold an index fund for 30 years while the market drops 40%. The same mental shortcuts that kept your ancestors alive are now costing modern investors billions of dollars every single year. These shortcuts have a name. They're called cognitive biases. And today, we're going to meet the most dangerous ones face to face. Let's start with something called loss aversion. In the 1970s, two psychologists, Daniel Kahneman and Amos Tversky, ran a simple experiment. They asked people to choose between two scenarios. Option A, a guaranteed win of $50. Option B, a 50-50 chance of winning $100 or winning nothing. Most people picked option A, safe and predictable. But here's where it gets interesting. When they flipped the experiment to losses, the behavior completely changed. People would take wild gambles just to avoid locking in a loss. What that tells us is this: losing $100 feels roughly twice as painful as gaining $100 feels good. That's not logic. That's emotion wearing the costume of logic. And it's why so many investors hold dying stocks for way too long. Now let's talk about the bias that feels the best but costs the most. It's called overconfidence bias. After a few wins in the market, something shifts in your brain. You start to believe that you have a gift, that you can see patterns others can't, that the rules don't quite apply to you. Studies show that the average retail investor significantly overestimates their own ability to beat the market, and the more someone trades, the worse their returns tend to be. Not because they're bad people, because overconfidence leads to overtrading, and overtrading destroys returns through fees, taxes, and poor timing. The most dangerous investor in the room isn't the nervous one. It's the one who just had a lucky streak and now believes they're a genius. Here's the one that gets entire generations of investors into trouble at the same time. It's called herd mentality, and you've seen it play out in real time even if you didn't know the name. Bitcoin in 2017, GameStop in 2021. Every single speculative bubble in modern history follows the same script. Someone makes money, their friends notice, more people pile in, social media explodes, and by the time the average person hears about it and jumps in, the smart money is already walking out the door. Herd mentality works because of a very human fear, the fear of missing out. FOMO is not just a social media problem, it's a hardwired biological response, and on Wall Street, it's one of the most expensive emotions a person can feel. Okay, this next one is subtle, but it's everywhere. It's called anchoring bias. And it works like this. You buy a stock at $100, the stock drops to $60, and suddenly, in your head, $100 becomes the magic number, the reference point, the anchor. You tell yourself you'll sell when it gets back to $100. You won't take a loss, you'll wait it out. But here is the cold reality. The market has no idea what you paid for that stock. It does not care about your anchor. The price you paid is completely irrelevant to where the stock goes next. Anchoring keeps people trapped in bad investments for years, waiting for a return to a price that may never come. Letting go of your anchor might be one of the most profitable mental moves you ever make. Now let's talk about a bias that the internet has made 10 times worse. Confirmation bias. This is your brain's tendency to seek out information that agrees with what you already believe and dismiss anything that challenges it. You decide you love a certain tech stock, so suddenly every positive article about that company seems obviously true, and every warning sign feels like the opinion of someone who just doesn't get it. Social media algorithms make this catastrophically worse. They show you more of what you already agree with, so your echo chamber just keeps getting louder. The investors who beat the market long term are not the ones who found the perfect stock tip. They are the ones who actively sought out opinions that made them uncomfortable. That's a rare and powerful skill. Here's a bias that sounds smart, but is actually a trap. It's called the gambler's fallacy, and it goes like this. A stock has dropped for 5 days in a row, so you think it's due for a bounce. But markets are not roulette wheels. Past patterns do not guarantee future direction. Every single trading day is statistically independent of the last. The gambler's fallacy makes people buy into falling knives because they feel mathematically overdue for a reversal. It makes people sell during winning streaks because they assume the good times can't continue. Reality does not owe your portfolio a correction. The market doesn't balance itself out for your convenience. Understanding this one bias alone could save you from some of the most painful investment decisions of your life. So now you know the enemy: loss aversion, overconfidence, herd mentality, anchoring, confirmation bias, gambler's fallacy. These aren't character flaws. They are features of a human brain operating in an environment it was never designed for. The good news is awareness is the first firewall. You cannot eliminate these biases, but once you can name them, you can pause before they act through you. Some of the best investors in the world use a dead simple system. Before every major financial decision, they write down their reasoning. Then, they ask themselves one question: which bias might be driving this decision right now? That 5-second pause has been worth more to some investors than years of market analysis. The journal on that desk might be worth more than any stock-picking course. Investing is not a game of finding the right information. It's a game of managing the wrong instincts. The market will always be there to test you. It will drop when you need the money. It will spike when you're too scared to buy. It will tempt you into trends that evaporate. But the investors who build real wealth over time are not the ones who